The average true range ATR indicator, originally introduced by J. Wells Wilder in his 1978 book New Concepts in Technical Trading Systems, is widely regarded as one of the most powerful and underutilized tools in a trader's arsenal, especially when it comes to managing volatility, refining entry and exit points, and assessing market sentiment across various timeframes, instruments, and asset classes. Unlike oscillators that attempt to predict direction or trend indicators that smooth price data, the ATR focuses entirely on measuring volatility, purely the degree of price movement regardless of its direction, which makes it uniquely neutral and highly versatile for both novice and professional traders who wish to master dynamic markets, whether Forex, crypto, stocks, futures, or commodities. Understanding the ATR starts with knowing how it's calculated. At its core, the ATR represents the moving average of the true range over a specific period, usually 14 periods by default, and true range is defined as the greatest among three values. 1. The current high minus the current low. 2. The absolute value of the current high minus the previous close. And 3. The absolute value of the current low minus the previous close, which ensures it accounts for gaps and limit moves, giving a more realistic depiction of actual market movement than simple high-low calculations. Once you understand the math, the real power of ATR emerges when it's applied contextually. For instance, high ATR readings indicate heightened volatility, suggesting larger potential price swings and often signaling breakouts, major news events, or market turning points, while low ATR readings reflect periods of consolidation, calm, or indecision, often preceding large moves. This duality makes ATR extremely useful in volatility-based strategies. In practice, the ATR can help traders avoid false signals during sideways markets and prevent getting stopped out too early during volatile ones, which is where its utility in setting stop losses truly shines. Rather than using arbitrary fixed stops like a flat 20 pips or $1 amount, smart traders use the ATR value to determine a dynamic stop loss that adapts to current volatility. For example, setting a stop loss at 1.5 multiplied ATR below the entry point allows room for natural market noise without compromising risk management. Similarly, take profit levels can also be based on ATR multiples, creating logical, math-based trade management systems that reduce emotion and guesswork. Scalpers may use lower period ATRs, for example, 5 or 7, while swing or position traders benefit from higher values like 14, 21, or even 50 depending on the asset and time frame. But ATR isn't just for stop losses. It's a critical tool in strategy optimization too, often used to filter trade entries. For example, some traders only enter trades when ATR rises above a certain threshold, signaling increased momentum and more favorable risk/reward setups. In breakout trading strategies, a sudden spike in ATR can confirm that a breakout has true conviction behind it, rather than being a fake-out caused by thin liquidity or market noise. ATR can also be used in trailing stop systems where the stop dynamically adjusts to price and volatility, often referred to as an ATR trailing stop or chandelier exit popularized by Chuck LeBeau. This method ties the trailing stop to a multiple of the ATR below for long trades or above for shorts the highest price since entry, allowing for gains to be locked in while giving the trade enough breathing room to develop. Furthermore, ATR's neutrality makes it a universal tool. It can be combined with virtually any strategy, whether trend following, mean reversion, breakout, or scalping, acting as a filter, confirmation, or management component. It can also work alongside indicators like RSI, MACD, Bollinger Bands, or moving averages. For example, combining an RSI oversold signal with an increasing ATR can signal a high probability reversal with strong momentum, while a breakout above resistance confirmed by a rising ATR may support a bullish trend continuation entry. Beyond discretionary trading, ATR plays a critical role in algorithmic and automated systems, often coded into bots to manage risk or filter trades, especially in high-frequency environments where volatility awareness is crucial. When used correctly, ATR helps traders think probabilistically instead of predictively. It doesn't try to tell you where the market is going, but how far it might go, how fast it's moving, and how much risk is involved. which are often more important questions than direction alone. One of the most overlooked aspects of ATR is its psychological component. By visually seeing how volatility changes, traders can adjust their expectations and emotional responses accordingly, avoiding overtrading during high volatility periods or underestimating risk during low volatility traps. It's also useful in identifying regime changes. If a market that typically has an ATR of 0.50 suddenly starts registering 1.20 or more, it may indicate a fundamental shift, such as a news catalyst, earnings report,